Good morning. This is Bloomberg Daybreak Europe. Happy Friday. I'm Tom McKenzie in London. These are the stories that set your agenda. Traders stand by for what could be the most consequential US jobs report of the year. The Fed's Daily and Goolsby say lower rates are coming as the labour market cools. Former Brexit czar Michel Barnier becomes France's new Prime Minister as he bids to end the political turmoil of the past 2 months. We bring you reaction throughout the programme. Plus, lower taxes, less regulation. Donald Trump vows to cut America's corporate tax rate from 21 to 15%. He says Tesla CEO Elon Musk will lead a task force on reforming government spending. Jobs, jobs, jobs. That is the focus of these markets today. Non-farm payrolls coming out. The estimates, of course, later today, 165,000. The focus will be on the unemployment rate as well. The expectation that it will actually move lower from 4.3% to 4.2%. What happens? The consequences of this non-farm payroll print in terms of how the markets assess the move from the Federal Reserve. As those officials say, from the FOMC, a cut is coming. How deep, though? 25 basis points or 50 basis points? European futures looking lower, down 0.1%. You are set for losses for the week for European stocks, 4 straight days of losses. And as you can see, futures pointing to further downside. Investors, you would expect, having sideline attitudes until we get the data out of the US. Staying on the sidelines. The FTSE 100 futures pointing low by 12 points. S&P futures currently looking at 5,507, down 0.1%. US markets as well, off to a little soggier yesterday. Nasdaq futures pointing low by 71 points. Let's flip the board and look cross-asset. You had further moves into treasuries yesterday. Yields down on the 2-year now in the week by about 20 basis points. 373 right now on the US 2-year. And that, of course, could be vulnerable as we look to that jobs data. Euro dollar at 111 right now. Brent, $72.83. Still down around 8% for the week, despite OPEC Plus coming out saying they will hold back on putting more oil onto the market, at least for now. Gold, 2,518, just up 0.1%. Let's cross over to Singapore. Ava Hong standing by for a deep dive on the Asian markets.
Yeah, Tom, we're seeing that anticipation really building ahead of the U.S. jobs print. These worries swirling about whether the Federal Reserve is behind the curve is prompting a bit more of a bearish mood across the region. It's pretty mixed. The TAIEX is managing gains for a second day as chip stocks recover. But if you take a look at the Bloomberg Asia chip gauge, it's actually headed for declines of about 5% for the week. So clearly hasn't regained the lost mojo from the NVIDIA meltdown. Now, we are having these Hong Kong markets, of course, shut because of the super typhoon that's skirting the city. So the Hang Seng is not on the board today, but flip the board. As I say, it's really about the U.S. numbers. And as the bearish mood comes through, we've seen the U.S. dollar extending declines in the Asia session. If we can just take a look at what we're seeing in the Asia currencies, these are among the ones that are the top performing today. The Philippine peso, the Thai baht as well. A lot of these Asia economies get most of their business from the US and China. And as China's growth really doesn't come through, it's fallen short. The onus kind of lies with the US. And that's why the data today takes on an added significance, because as our MLive colleague Mary Nicola has been talking about on the blog, it's not just about the size of the cut in September. It's also about why the Federal Reserve is doing this. Now, let's take a look at what we're seeing on dollar yen as well. It's been climbing, this Japanese currency, for 4 straight sessions, and we've seen it at the strongest level against the greenback since January. Today we got some comments from a former BOJ official saying, there could be 2 cuts this year, 2 hikes, I should say. But if you take a look at this, I just wanted to highlight the correlation between the yen as well as the Fed expectations. So certainly if we get a poor jobs picture, we could see further weakness in the dollar, and that could send the Japanese currency rallying. Tom?
Yeah, and potentially a further challenge to Japanese equities on that stronger currency in Japan. Avra Hong in Singapore with a check on the Asian markets as we lead up to the jobs data out of the US, of course, and the ripple effects to the Asian region. Talking of which, traders are looking ahead, of course, to that number. US payrolls, non-farm payrolls data later today, as we've been saying, which may determine, of course, the size of the Fed's interest rate cut this month. Our executive editor for Asian markets, Paul Dobson, standing by now for the analysis. Paul, what is the market expectation? What is priced in at this point?
The market is priced for a pretty middling looking jobs number, but with very much the risk of it being a deeply more negative number, being the sort of where the sort of skew is. So if you look at FX market volatility, for example, the market is priced for a pretty big move in the dollar against most of its major counterparts. And if you look at the skew, that's favoring the risk that the dollar will continue to weaken quite sharply. So people more worried about a bad number than they are hopeful for a good number. And that, of course, is because another bruising looking labour market figure could be enough for the Fed to decide that it needs to start its series of interest rate cuts with a 50 basis point move rather than a 25 basis point move, which would, as you were saying, tank those short-term yields and pull the US currency weaker.
So we're getting data out of the US on non-farm payrolls. We've been hearing from Fed officials as well, and we will continue to hear from them over the next 24 hours. We've heard from Mary Daly, we've heard from Austin Goolsbee, both suggesting that they are ready to go ahead with those cuts. Does anything that they've said change the pricing that the markets are now seeing? About 100 basis points of cuts by the end of the year, more than 200 basis points within 12 months. What do you make of the comments from these Fed officials?
Yeah, so I think if you look at them, take them one by one, Mary Daly was very much in line with what the Governor Powell was saying at Jackson Hole not too long ago, talking about the idea that, you know, the hiking cycle is definitely over. It's time to start cutting, and that any more deterioration in the labour market would be unwelcome. Those same words that were used by the Governor, talking about, so exactly, puts the focus back onto the numbers that we're going to get later today. I think Goolsbee, a little bit more interesting, and this is something that people are going to start to pay more attention to, I think, is what does that terminal rate look like? How far are we going to go with these interest rate cuts? Talking about the need for a series of cuts, not just, you know, kind of sporadic or kind of scattergun or quite a short cutting cycle. So market kind of is caught in two minds a little bit about how deep those cuts are eventually going to have to go. It seems like the consensus is that we will get to could get to as low as sort of 3% as being that kind of terminal rate, which is still a long way from where we are today, but it's nothing like where we were over much of the last decade, where interest rates were much lower. And so that is helping people to calibrate their expectations for the 2-year yield relative to the 10-year yield. And that is why we're seeing those variations and that fluctuation around the difference between the two and the shape of the yield curve right at this moment.
Yeah, and the debate about the neutral rate continues, doesn't it? We're hearing from Paulson, we've heard from Howard Marks, of course, of Oaktree Capital as well, around whether it's 3% handle, a 2 handle in terms of the neutral rate. That debate will, of course, continue, you would expect, in the days and weeks ahead. Bloomberg's executive editor for Asia Markets, setting us up really nicely, Paul Dobson, in terms of what to expect on a big day for these markets with the jobs data front and centre. The politics of the Eurozone, though, and France in particular, is also a key story for us this Friday. The new French Prime Minister, Michel Barnier, has made a plea for political parties to work together in order to move beyond uncertainty. France, of course, thrown into chaos more than 2 months ago after President Macron called a snap election. Speaking after his appointment, the new PM said his new government will act more than talk.
We will act more than talk. We'll try to find solutions coming from everywhere. The government will not pretend to have a superior knowledge. I have learned in my long public life that good ideas come from everywhere, often from the bottom, the most humble of people, when you take the time to listen to them.
OK, at this point, let's bring in Bloomberg's Caroline Cornat, standing by for us in Paris, covering all things French politics for us, of course. And, Caroline, I know you and the team have been waiting for this moment on tenterhooks. And finally, we have an answer. Why has Macron, though, chosen Michel Barnier?
Tom, that's really the only name that Emmanuel Macron came up with that he believes will not face a vote of no confidence. And the reason for that is that the National Rally have said that they will not vote a vote of no confidence and make this government collapse. So at least he could stay a little bit. As you know, he's a very well-known international figure, especially for you in the UK. He was in charge for the EU of the Brexit negotiations for 4 years and was considered very tough, very patient during those negotiations, especially when you had lots of divergence on trade, on fishing, on the period of transition, first with Theresa May, then with Boris Johnson. Before that, he was also EU Commissioner for Internal Markets, so he's very well known at the EU level, quite a reassuring figure for Brussels. Last time I interviewed him in Aix-en-Provence back in July, in the middle of those chaos, snap elections, he actually refused to say he could be a solution as a prime minister, but said his red line was any threat to the European project. In France, of course, he's been around for a very long time as well. He was first elected MP in 1978. He was European Minister, Foreign Affairs Minister, Agriculture Minister. He didn't even try to run for the 2022 presidential elections, but lost in the Republican primaries. Of course, the left wing today is feeling outraged. The far left leader, Jean-Luc Mélenchon, has said the election was stolen. The socialists said this was a denial of democracy. We'll see over the weekend if there are some protests that could possibly damage the credibility of the new Prime Minister, Michel Barnier.
OK, so the response then from the far left. Look, this is clearly one important piece of this puzzle, the anointment, or at least the appointment of Michel Barnier. What is next, though, to build out this puzzle that is the new French government and its policy agenda, Caroline?
You saw already the handover between Gabriel Attal, the youngest Prime Minister of the Fifth Republic, and Michel Barnier, the oldest, 73 years old, last night on these pictures. Over the next few days, he's going to have to form a government. That's going to be tough because he's probably going to take some personality from the center, but also has to extend a hand to perhaps the center left and the center right, as we've been discussing over the past couple of months. If he doesn't want to see his government collapse immediately, then he's going to do a general speech in parliament. That's when he could potentially face a vote of no confidence. And then there will only be a few weeks before he has to present a budget. The deadline is October 1st. As you know, France has been placed under an excessive deficit procedure by the EU Commission. Last night, Michel Barnier talked about telling the truth to the French about the budget. We already know that the deficit slipped to 5.5% last year, much higher than the target. And it's actually expected to rise even more this year, up to 5.6%, because already Bruno Le Maire, the previous finance minister, has warned about potentially too much spending from local collectivities, as much as 60 billion euros to find. And some analysts have told us over the past few days, right here on Bloomberg TV, that in fact, France could need even more austerity, perhaps as much as 0.3, 0.5% of new austerity in the new budget. That would be around the equivalent of the savings from the pension reform.
OK, so lots more questions that still need to be answered. And, of course, the implications for that budget deficit and potentially further cuts coming through, at least some cuts coming through for the French state. Caroline Conat, thank you very much indeed. Here's what else we're thinking about today, then. We have the answer in terms of French politics, at least when it comes to the Prime Minister. When it comes to economic data out of the Eurozone, 10 a.m. UK time, Euro area second quarter growth numbers will drop. Important if you think about the fact that the ECB is coming out with their decision next week. So that data we will be breaking for you live, of course, at 10 a.m. 1:30 p.m. meanwhile, UK time, it's the big one. We've been talking about this, of course, at the top of the show, and we will continue to talk about this because of the consequences for these markets. The jobs report out of the US, 1:30 p.m. UK time. Of course, do not miss that live coverage throughout the show and the market reaction. 1:45 p.m. meanwhile, we're going to be getting more speakers from the Fed. The Fed's Williams will speak. At 4 p.m, you're going to get the Fed's Waller as well. Chris Waller going to be speaking and reacting, no doubt, to the non-farm payrolls number. This after we've heard from Mary Daly and Austin Goolsbee, both coming out saying the time is right to start cutting, with Austin Goolsbee suggesting that the economic data justifies multiple cuts starting soon. Will we hear a similar message from Waller and Williams? Coming up, OPEC Plus pauses a production boost, but the price of crude fails to meaningfully bounce. We take a look at the oil market and what is next. Brent, $72 a barrel. And later in the show, low taxes, low regulations, low energy costs. That's the dream, at least. Republican candidate Donald Trump sets out his stall on the economy. We bring you the latest on the race for the White House. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday, everyone. Now, oil is heading for its steepest weekly loss in almost a year, and that's despite OPEC Plus members delaying an output increase. Let's get more then with Bloomberg Horizons anchor Jumana Pasechi, who joins us from Dubai. Jumana, the speculation this week, given the downside on oil, about 8% was the drop so far through the week, was that OPEC Plus would have to delay putting more oil and more barrels on the market. They finally come out with a statement saying they will do that. Talk us through what we've been hearing from the cartel and their allies and where this leaves the market.
Yeah, certainly. With that huge price drop, as you talk about, with the oil complex down 8% over the course of the week, it was over to you as far as OPEC Plus were concerned. All eyes were on how they were going to react. Yesterday afternoon, they put out a statement saying that the 8 countries that had announced those voluntary cuts, those 2.2 million barrels per day voluntary cuts that were introduced in 2023, had held a virtual meeting. And on the back of that meeting, they decided to push back the timing of tapering those voluntary cuts. And essentially what we're seeing now is instead of starting the unwind of the cuts as of October the 1st, they've now just pushed it back by 2 months. They're going to start on December the 1st of this year, keeping the exact same tapering schedule as they had in place, and therefore now scheduled to end at the end of December 2025. So just a pushback by a couple of months here. There are also a couple of lines in the statement talking about the 2 serial offenders when it comes to overproduction. Those are Iraq and Kazakhstan, saying that they have been urged to start conforming with the quotas and to come up with compensation plans to reveal to the market how they're planning on compensating for all of the overproduction that they've introduced since January 2024. So those are a couple of highlights that came out from the OPEC Plus statement. But ultimately what you saw, Tom, is a bit of stabilization come through with the price of oil, but it didn't last very long because at the end of the day, people read it as not them ruling out the possibility of putting further barrels to the market. They've just pushed back that decision by 2 months.
Yeah, and Jumana, that leads me on to a pretty obvious question, which is market expectations then around whether or not they're just going to have to kick the can further down the road, whether in 2 months' time we revisit this question and they're going to have to kick it back even further. What are the markets thinking about in terms of what could determine that decision? Or does the pressure within the cartel and its allies mean that they're going to have to finally, in 2 months, actually put some oil back on the market?
Yeah, well, you raise a good question there about OPEC Plus cohesion. It's always a question. But the fact that they are able to still come together and make these decisions tells you that they are intent on coming out with decisions at a group level. Certainly a lot of pressure on the countries that are overproducing. The UAE just also managed to carve out their own quota back at that June meeting to start producing more. So there will be members pushing for further market share. But I will say, as we've been talking about all of this week, the main driver here seems to be the outlook for global demand. The big catalyst for the drop in the price of oil this week was not data coming out of the US. It wasn't OPEC. It was actually that China PMI data that disappointed to the downside. So keep an eye out on the data that comes out from China, the demand signals there. In addition, from a seasonal perspective, we're entering into the refinery maintenance season in the US, which means that the broader demand for crude oil could subside somewhat just from a seasonal perspective. In addition to that, keep an eye on the technicals. I was speaking to some traders yesterday, and they tell me that as we approach that $70 level for Brent, you could start to see some gamma selling, so some options activity get triggered, in which case you would see further downside momentum, in which case you would be on alert for further bearish moves to the downside. So keep all of those things in mind. It's not just demand, but also some of the technicals, and then, of course, the non-OPEC supply that we've been speaking about as well that is still hitting the market.
Okay. Really interesting on the technical line as well. That's the first time I've heard that. 72.78 right now on Brent. Bloomberg's Horizons anchor Jemima Pesce on what to watch out for in these oil markets in the days ahead. Coming up, power grids feeling the heat under intense demands for energy. We're going to look at ways to boost investment in critical infrastructure. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, analysis by Bloomberg has found that investment in US power grids hit a record $111 billion last year. For more, we're joined by Felicia Aminoff, Senior Associate in Bloomberg NEF's grids team, for the details. So, Felicia, thanks for joining us around the studio this morning. Is policy then, does that suggest that policy within the US is working to drive these investment rates higher and have a material impact on the grid infrastructure?
Yes, we've certainly seen very sort of promising policies like the Inflation Reduction Act that has allocated several different funds to supporting power grids. And that's definitely a contributing factor to the growing grid investment we're seeing in the US. And also in Europe, we've seen a big policy push. And globally, we've tracked $326 billion going into power grid investment last year. And our analysis shows that this could grow actually 13% this year. So continuing to grow.
OK, that's really interesting. So 111 billion in the US, 326 billion globally, and an expectation that could grow 13% this year. You're talking about the policy stability and at least transparency and certainty in the US as a result of the Inflation Reduction Act. Where is the funding coming from at this point?
So although this funding in the US has been very promising and very important, most grid funding actually is private. And around 60% of grid funding is typically borrowed capital. So that's why the bond markets are so important. And especially in Europe, in the US as well, to some extent, we've seen the green bond market really growing. So many utilities raising green bonds to fund their grid investments. And that's a recognition, again, of how important the power grids are for the energy transition. OK, when you talk about green bonds, I'm thinking about the shift to renewables. And there's been a big debate, at least a question mark, about how you get renewable assets onto the system more quickly, given that a lot of these grids need to be upgraded. The infrastructure is very dated. It's a bit of a bottleneck. Is that improving? So things are actually still getting a little bit worse before they are getting better. So we were talking about policy, and one of the promising policy developments has been to improve the administration on how you connect renewables faster to the grid. But as long as the actual building out of the grid can't be accelerated, there are large projects, they take a long time. So you have a situation where renewables connect before the grid is fully ready. And that can lead to what we call curtailment, where the grid operator instructs, for example, a wind plant to turn off when the grid is overloaded. OK, Felicia, thank you very much indeed. Really important analysis. You can get more, of course, on the website and on the Bloomberg terminal. Felicia Aminoff, Senior Associate in Bloomberg NEF's grids team on the infrastructure investment occurring there. Coming up, a new French Prime Minister. We have the details, the implications and the market reaction to the politics of France. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Traders stand by for what could be the most consequential US jobs report of the year. The Fed's Daily and Goolsby say lower rates are coming as the labour market cools. Former Brexit czar Michel Barnier becomes France's new prime minister as he bids to end the political turmoil of the past 2 months. We bring you reaction throughout the programme. Plus, lower taxes, less regulation. Donald Trump vows to cut America's corporate tax rate from 21 to 15%. He says Tesla CEO Elon Musk will lead a task force on reforming government spending. Let's check in on the markets. European stocks set for losses for the week. 4 straight days of losses, but of course the pivotal moment will come with the US jobs report. Expectation you'll get a print of around 165,000. The focus as well on the unemployment rate and to what extent this will change the bets around whether the Fed goes 25 basis points or goes for a jumbo cut on September the 18th. European futures, though, down by 0.2%. It's been a negative week for European stocks after the records hit this time last Friday. FTSE 100 futures pointing lower by 19 points. S&P futures also off now by 0.2%. And Nasdaq futures looking for a tough and challenging day as well, down 0.5%, despite the fact that Nvidia came back a little in the session yesterday. Let's flip the board and look cross-asset. The move into treasuries continues. The Bloomberg dollar index is down. The dollar is under pressure. Yields down again in the session, down 2 basis points on the front end of the 2-year at 3.72. Yields have come down at the 2-year level by about 20 basis points just this week. Euro dollar at 1.11. A little bit of strength coming through for the single currency. We look ahead to the ECB's decision next week, of course, in terms of rates. Brent 72.79. Not a lot of movement, just up 0.1%. And that's despite the fact OPEC Plus came out and said they will be delaying their increase in output by 2 months. Gold 2,520, up 0.2%. Worth noting, back to gold, back to oil, down around 8% so far this week, and WTI remains below $70 a barrel. Let's go back to one of our top stories now, the politics of France. Michel Barnier's appointments as the new French Prime Minister. Investors, they expressed relief at the announcement, ending a period of political deadlock, at least for now, and allowing the government to focus on fixing the nation's finances. Joining us from Paris for reaction is Mabrouk, Chetouane, head of global market strategy at Natixis. Mabrouk, is the appointment of Michel Barnier the name that markets were hoping for?
Good morning. This appointment is a kind of relief for the markets because, we are at the end of 2 months of uncertainty in France. And then, clearly, the market were expecting the new prime minister, but this is not enough, to see, the spread compressing in France. Why? Because, this name is the synonymous of more stability, more consensus in France, and this is a key thing that Emmanuel Macron, the president, was looking for. Consensus is clearly the key word when it comes to the French policy now, because, we have to deal with, the new prime minister has to deal with a very fragmented parliament. We have, the far left and the far right, parties that are, keen to increase, let's say, fiscal spendings in the context where, the room of maneuver of the new government are limited. So we have ended, a period of negotiation between the president, Emmanuel Macron, and all the parties. And now I think, my opinion is that we are entering in a new period of negotiations between this new government, led by Michel Barnier, and the parliament. So another period of negotiation, which could be, which could lead, to a positive outcome for the equity market and for the bond market, or to let's say something more volatile and more, complicated for the equity and for the bond markets.
Okay, so given that context, there is still risk of further volatility. You have that spread premium then of French debt over its German equivalent, about 70 basis points right now. Mabrouk, when do you see that premium being erased for French assets, for French debt? How long before that returns to pre-political crisis levels?
Well, some key figures in order to understand where this period is coming from. Last year, we had a 5.5% fiscal deficit in France. And now, I mean, what the market are expecting is a reduction of the fiscal deficit. So all else being equal, so far the deficit is not expected to decrease because, I mean, there is no measures decided by the government yet in order to reduce, I mean, this deficit. So these 70 basis point spread that we are seeing now in the market has no reason, I mean, to disappear in the near term because there is, I mean, clearly difficulties on the fiscal policies. So now the key thing that we need to monitor is what could be the roadmap of the new government. What will be the next, I mean, measure that he will implement in order to reduce, I mean, this fiscal policy. So the numbers that we have so far is that the fiscal deficit will increase by another 0.1% in this year, at 5.6% if nothing is decided. Hopefully, I mean, we have good reasons to see, I mean, a reduction in spendings in order to reduce the deficit.
The CAC 40 year to date down around 1.2, 1.3%. So it's underperforming quite significantly its peers in Europe. It's underperforming clearly the S&P in the US. It's underperforming the FTSE 100 here in the UK. When does that change? Is there a buying opportunity here, Mabrouk, for French equities?
That's an excellent question. Of course, I mean, when you compare the performance of the French equity market to, I mean, the other major equity markets, of course, we can say, okay, this spread is clearly an entry point for investors. But we need to be extremely careful because the market now are more and more, the investors are more and more selective. They are, I mean, of course, looking at, I mean, equity market more carefully because the beta has left, in my opinion, the market. There is no positive trend no more in the equity market. Investors are more, I mean, diversified. They are more looking for, I mean, protections in their investment. And this is why, if there is no positive news coming from the government of Michel Barnier, clearly there is little chances to see this equity market, this French equity market, increasing. At a time where, of course, I mean, when you look at the different segments of the equity market of the French one, clearly the small cap have been severely, I mean, damaged by this political turmoil. And clearly we need, I mean, more let's say, guidance from the monetary policy first and more growth in order to see this part of the equity market increasing quite significantly. But this is not, I mean, we need to wait a bit more to see, I mean, these things happening in the near term.
OK, it sounds like you would advise on sitting on the sidelines, at least for now, until you get more clarity. I wonder, and you talk about monetary policy, Mabrouk, we look ahead to the ECB decision next week. Do you expect a rate cut and second rate cut from the ECB in this cycle? And to what extent could that be a catalyst for European equities?
It could help, definitely. I mean, if there is, the ECB situation is a bit different compared to the Fed because the Fed has clearly announced what they are going to do. There is more uncertainty when it comes to the ECB monetary policy decisions. We don't know exactly what is the timeline of the ECB, and if they are, I mean, preparing the market for another or two other rate cuts by the year end. Maybe in September, maybe in October, but definitely, I mean, when you look at the data, the economic environment, there is a need to lower their interest rates. So the ECB, is about, I mean, to cut rates. It could help, I mean, the markets, the equity market in particular, but we have also to bear in mind that the market is already, I mean, has already priced in, I mean, these rate cuts, and maybe, I mean, the consequences on the equity market could be, I mean, limited because the market is a bit too demanding regarding when it comes to the monetary policy. So definitely the ECB will cut. We don't know exactly when, but probably in September or next month in October. And clearly this signal is already priced in by the market and it will have a limited impact on the equity market.
OK, so we have the domestic factors, the politics of France, we have the Eurozone, the ECB in that decision. And then, of course, we have the demand factor for European goods coming through from China. I'm just thinking of the luxury stocks in France, maybe the cognac makers as well, maybe some of the automakers. To what extent is the China story priced in to, for example, the luxury sector of France right now?
Well, this is an excellent question because, we have, this luxury sector in France, depending on the Chinese business cycle. If there is a symmetric in Germany, the manufacturing sector is clearly depending on the Chinese, business cycle as well. So what is the current situation in China now? The Chinese economic situation is clearly keeps disappointing investors, and this is not a surprise because the issues in China are more structural than the market, than the investors were expecting. Seeing the Chinese economy recovering will take time, and the part of the segment of this economic downturn is damaged by this situation is demand. In that context, if there is no support coming from the fiscal policy, for example, to sustain the demand side of the economy, there is little chance to see this luxury sector rebounding or continuing to increase. This sector is clearly under the pressure of this Chinese business cycle, and there is no positive things or positive signals coming from this economy at this stage of the business cycle.
Okay, Mabrouk, Chetouane, Natixis head of global market strategy. Thank you very much indeed with the take there in terms of the China impact, but as well a deep dive in terms of the politics of France and the pick of Michel Barnier as French Prime Minister and what that means for these French markets. We'll stay on that topic right now because we caught up with the former ECB President Jean-Claude Trichet for an exclusive interview. We asked him about central bank policy and France's new Prime Minister.
The market is waving between 25 and 50. I will not pronounce myself and choose myself. They know better, if I may. The Open Market Committee is serious. They have proved that they were really determined to do their job. They increased rates by 11 times, and it would be the first time they will decrease rates. So we will see. In my opinion, they did a very good job. And decreasing rates would not be absurd in the present situation, clearly, and the market is totally anticipating a decrease of rates. Now, how much is another story? Yeah. It was overdue that we have a Prime Minister. I think that the choice of Michel Barnier is a very good one. I know Michel Barnier. I think it's a man who inspires confidence, and including, of course, in Europe, where he was so instrumental. In the Brexit negotiation, but he was minister in France. He has a lot of experience. So good choice in my opinion. And of course the difficulties are enormous, including political, but also not only political, also in terms of financial problems and fiscal problems.
Former ECB President Jean-Claude Trichet speaking to us exclusively. Now to some other stories making the news this Friday. The US is imposing new export controls for critical technologies, including quantum computing and semiconductor goods. The move targets China and other adversarial nations and will include advanced chip-making tools and cutting-edge semiconductor technology. And Bloomberg has learned, staying on the chip space, that Intel is weighing a sale of part of its majority stake in Mobileye as part of a major strategy overhaul to improve performance. Sources say Mobileye has a board meeting later this month where Intel's plans will be considered. Shares of the struggling automated driving systems provider slumped in US trading. Meanwhile, Reuters reports that Qualcomm has explored the possibility of acquiring portions of Intel's design business. Broadcom fell more than 6% post-market after its fourth quarter revenue forecast missed. The Apple chip supplier's AI growth was unable to offset the company's non-artificial intelligence operations, growing more slowly than anticipated. And the European Union Aviation Safety Agency will require one-time inspections of Airbus SE A350 engines. That's after a mid-air fire on a Cathay Pacific flight earlier this week, which forced the airline to temporarily ground some planes. Operators must check for damage in flexible fuel hose connections inside engines powering the A350-1000 over the next 30 days. Coming up, Donald Trump unveils economic plans, including a tax cut to corporate tax rates and tapping Elon Musk to head up an efficiency task force. We bring you the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday, everyone. Now, Donald Trump has pledged to cut the corporate tax rate, slash regulations, and audit the federal government as he pitched his economic agenda to Wall Street yesterday. The Republican candidate, of course, for US president, says he will prioritize the country's economy.
To further support the revival of American manufacturing, my plan calls for expanded R&D tax credits, 100% bonus depreciation, expensing for new manufacturing investments, and a reduction in the corporate tax rate from 21% to 15% solely for companies that make their product in America.
Join now for the details then and the reaction in terms of the context by Bloomberg opening trade co-anchor Kriti Gupta, of course, has a finger firmly on the pulse of this US election. Kriti, this sounded like a full-throttled, a full-blooded pitch to corporate America from Donald Trump. And clearly there is a deep division now in terms of the policies coming through from Kamala Harris on the economic front and Donald Trump. What do you make of what we heard?
Well, I think the thing we start off with is these are two candidates we've heard a lot from this week on the economic front, to your point, both trying to appeal to voters, because the most kind of votable topic right now in American politics is actually the economy. It's inflation, it's affordability, more so than the likes of immigration, abortion, gun control, which of course poll highly as well. But this is where you're trying to see Donald Trump and Kamala Harris try to make strides, not only with the voter base, but with their donors as well, specifically on Wall Street. And that's where these comments really come in handy, around that 15% figure that Donald Trump floated. Remember, this is coming in comparison to Kamala Harris talking about 28% by comparison. Still significantly lower than what President Biden was proposing. But Donald Trump is really leaning into one of the major pillars, one of the major success stories that he kind of had in his first term in office. And this is significant because not only did those Trump tax cuts, yes, it made the deficit a little bit larger, and yes, it did come with a lot of criticism on what the distribution actually looks like. But net, and economists will agree, those tax cuts spurred the economy. They made more money for more people, regardless of what spectrum you earn in terms of the income bracket. So this is something that he's leaning into, and he's just trying to build upon that. And I think that's a key piece of the equation, because the flip side of this, the criticism, is how he's going to fund this tax cut, given he's going into a deficit. And his answer to that is, of course, tariffs. OK, I want to push a little bit more on that. So he's already cut the corporate rate to 21%. He did that in his first term. These are plans being outlined by Trump. We had the plans from Kamala Harris, and of course it all depends on what the mix is in terms of the House and the Senate and whether or not they have control and can push through these plans. Right. But in terms of the funding question then, is there more detail on that front? Is there skepticism from his donors, from economists around that? Is there any concern that this would be unfunded? So all of the above. And right now, from a market's perspective, from an economist's perspective, the deficit is only getting larger and larger. Remember, the deficit, the budget ceiling, gets hit in the second week of January. So prior to whoever the new president is taking office, and even if, Washington works at lightning speed, you still can't make the time. So basically, you're going to have this decision end up, in terms of the budget and the deficit, show up in Congress more so than the president. That being said, the tax cuts that Trump did kind of put forward in his first term, they expire in 2025. And this was something that was imposed in 2017. So the question has been, do we wait for those tax cuts to roll off under a Kamala Harris potential presidency, or do we extend them? And he's making the argument, not only extend what's existing right now, but to actually make it even lower. To your point about the economists, the concern, though, is that this could actually be inflationary, not because of the tax cuts themselves, but because of the way he's talking about funding them, and that is the tariff story. Goldman Sachs saying that that could show up as quickly as a 0.5% GDP hit in the back half of 2025. And Trump also saying, interestingly, that he wants to start cutting across the government and, interestingly, name-checking Elon Musk. In fact, tapping Elon Musk for this role. Take a listen.
I will create a government efficiency commission tasked with conducting a complete financial and performance audit of the entire federal government and making recommendations for drastic reforms. We need to do it. And Elon, because he's not very busy, has agreed to head that task force.
All right, so Elon Musk then apparently being tapped for this potential role. What do we make of this?
Well, this is, again, let's lean into the politics here. Look, Elon Musk is a donor. He's a major Trump supporter. He also has a massive following as well and is a key voice in the EV space and in the car space generally. That being said, this is also coming at a time when Kamala Harris is trying to court the labor vote right now in the Rust Belt. So when it comes to the car making space and the folks in Silicon Valley, but also in the Rust Belt that are trying to work in either direction, trying to actually vote and figure out which presidential candidate is better for the industry, Elon Musk plays a pretty big role here. But of course, we also know that President Trump has started tweeting on X, formerly known as Twitter. He was on a live interview with Elon Musk. Elon Musk got that first interview prior to any of the American networks. So there's a little bit of a friendship forming here.
The dynamic is fascinating from the CEO of a company that, of course, was funded and bailed out, essentially, by an Obama administration loan or grant as well to Tesla back in the day. Kriti Gupta with the latest in terms of what we've been hearing from President Trump, former President Trump, and his economic plans. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Happy Friday. It is all about the jobs data out of the US for these markets. And just a recap of some of the numbers that have come through already this week in terms of the jobs. Do not forget that the job openings were higher. And in terms of the layoffs, the job openings were smaller than expected, so fewer job openings and more layoffs from the JOLTS survey. And then in terms of the private payrolls as well, coming in well below the estimates of 99,000, suggesting that maybe we are set for a softer number. The top-line forecast coming through from the team at Bloomberg Economics is around 165,000 in terms of the numbers that we got through in terms of the forecast, 165,000, which would be up significantly from the July print, of course. But in terms of seasonally, you're still close for an August to about a 2-year low. So that's the number that is forecast then, 165,000. There's going to be scrutiny of the unemployment rate as well, which is at 4.3%. Will that move lower to 4.2%? That is expected. Of course, that number is so consequential for whether or not you get 25 basis points or 50 basis points. And here's the picture in terms of how that 165,000 estimate fits in across this historical context. And again, it would be and is the lowest estimate that we've seen in 2 years. You are hearing those calls now from FOMC members, and we've heard that from Austin Goolsbee, around the need to cut and have a number of cuts coming through. The data is lining up for that, he said. Let's flip the board quickly and look at the dollar softness because, yes, weaker and lower yields weighing on the US dollar. Consequences globally of a softer dollar, of course. You've seen about a 20 basis point move lower at the front end in terms of the 2-year on those yields. So watch the dollar and the implications and the volatility expected to pick up around this jobs data. Stay with us. The opening trade is next. This is Bloomberg.